Hello, Accounting 101 students. In this part of the video, we are continuing the transaction analysis that are included in our Chapter 3 study guide. So far, we went through the first 7 examples. Now we're going to go through examples 8 through 13 in our study guide. And hopefully by now you're going to start getting the hang of how these journal entries are being recorded. So our example on May 17th includes the company paying $2,500 for employee salaries. So anytime you see the word paid, that means there is a decrease in cash. So you're going to include minus $2,500 in the cash column. And the reason why we had that decrease in cash is because we had to pay for salaries and wages expense, which is going to reduce the retained earnings by $2,500. So our journal entry will be recorded on May 17th. And the date of the transaction is really important because you're going to utilize that date for the time period when you're putting together or summarizing the information for the income statement and the retained earnings statement and the statement of cash flows. So our journal entry will have a debit to salaries and wages expense of $2,500, and we're going to record a credit to cash because there is a decrease in our asset account, which is noted with a credit, and the dollar amount is going to be included in the credit column. So our description, paid employee salaries. Then we have May 20th. The company paid for the supplies purchased on account on May 3rd. So it's very important to do your journal entries in order because sometimes your later journal entries are going to be related to transactions that happened earlier in the period. We already purchased the supplies, so there's going to be no changes to the supplies account. All we're doing is paying off that accounts payable balance we had. We had an accounts payable balance, and we need to look at our earlier transaction. So I'm going to go up to May 3rd, and I'm going to see that we spent $500 of supplies on account. Now we need to reduce this accounts payable liability and make it go down to 0. So we're going to include negative $500 for accounts payable. And the decrease in liabilities is going to match up with the decrease in cash of $500. So both of these are decreasing by $500. So on May 20th, we're going to record a debit to accounts payable. Accounts payable is a liability account. When we have an increase in our liabilities, that'll be a credit. When we have a decrease in our liabilities, it's going to be a debit. And we also know that we had a decrease in cash, which is an asset account. So when our assets go down, that's going to be a credit. So I'm going to include in the dollar amounts in the debit and credit columns. And our description can be payment for the supplies, which we already purchased. Then on May 23rd, we received a cash payment of $1,200 for services performed on account on May 15th. So you might remember that on May 15th, we already performed services, so we already recorded revenue during the time period that we performed those services, and we recorded our accounts receivable. Okay, so this was on May 23rd, It's always helpful to go back to your previous transactions. So we want to go back to May 15th. Remember the amount that's on account is $4,200. So what happens on May 23rd is that we're receiving a portion of that amount from our customers. Not the entire amount, but a portion of that amount. So we're going to increase our cash by $1,200, and we're going to reduce our accounts receivable by $1,200. So there is going to be less money that is owed to us because we're actually collecting the cash with a debit on May 23rd. And we no longer want to follow up with that customer and ask them for the entire balance. We only want to ask them about the remaining balance. So we need to reduce this asset. And one of the things to note is that this particular transaction only impacted the asset side of the accounting equation. You can have transactions where you're going to have an increase in one asset and a decrease in another asset. Okay? So sometimes that happens when you're going to purchase inventory with cash, or supplies with cash, or fixed assets with cash. In this example, we reduced our accounts receivable balance because we received cash. So we received our cash from the customer. We did not perform the service again. We only received the cash from the service that was provided before. And then we're going to be on May 26th, where we borrow $5,000 from the bank on a note payable. So anytime you borrow money, that means you have an increase in cash. And we're going to have a corresponding increase in our note payable. So our liabilities went up and our assets went up. So on May 26th, we're going to record a debit to cash for the $5,000 that we borrowed. And we're going to have a corresponding increase in our notes payable liability account. Anytime your liabilities go up, they're going to go up with a credit. So that's going to be $5,000. Borrowed money from bank. And you can be as brief in these descriptions as you want to be, or you can be as detailed as you want to be. But generally in real life, when companies record their journal entries, they need to always have the supporting documentation for the numbers included in the journal entry. So now in transaction 12, we are going to purchase office equipment for $2,000. And what's interesting is that we're going to pay for a portion of that office equipment with cash, but the balance will be on account. So we're going to note that we're going to have an increase in our fixed assets. So specifically, the equipment account is going to increase by $2,000. We're going to pay for this in a portion of cash. So we're going to decrease our cash by $200. So the remaining amount, if we think about it, we have $2,000 that we need to pay for. We are paying $200 right now. So that means that the remaining $1,800 is on account. So we're going to have an increase in our accounts payable of $1,800. So in this journal entry, you're going to use up more lines. And this is something that happens in the normal course of business. The account that we're going to debit will be equipment, which is going to increase by $2,000. So we're going to have an increase in our assets of $2,000. the accounts are going to credit. We're going to credit cash for $200 because we have a decrease in our cash asset. We also are going to record a credit of $2,000 to accounts payable because we have an increase in our liabilities. So you can see that what column our debits or credits are included on does not necessarily correspond with the plus and minus signs. Okay, you have to think about what's going on with the account and how is it categorized and what are the debit and credit rules for that particular account. So cash is an asset account. When it increases, it'll be a debit. When it decreases, it'll be a credit. Accounts payable is a liability account. So the rules are opposite for the liabilities. When we have an increase in our liabilities, that'll be a credit. When we have a decrease, that'll be a debit. So we're going to note the description: purchased office equipment, paid $200 cash, remaining balance on account. Next, we're going to have our transaction on May 30th. We paid $180 for utilities. So anytime we see the word paid, that means there's a decrease in cash, which will be a credit when we record that journal entry. And the reason why we made that payment was for utilities expense. So minus $180 for our expense area. And our journal entry is going to be recorded on May 30th. We're going to record a debit to utilities expense, and the amount will be $180. And we're going to record a credit to cash of $180. And the reason for that is paid for utilities. So the last part of this problem, if you want to do this, is you can go ahead and figure out, does your accounting equation balance out? If you want to go ahead and take all of the dollar amounts from all 13 transactions, you want to take the amounts that you noted for cash from the very beginning and add and subtract those numbers and include in a number for cash. Then for accounts receivable, you want to add and subtract all of the numbers from all 13 transactions and include in the balance. The same for inventory and all the remainder of the accounts. And then you want to summarize, what is my total assets? So you want to add together all the asset accounts. And you want to see if that equals to what you have in your liabilities and equity. So I paused the video just so I can include in all of the numbers. So when I added and subtracted all of the numbers, you can see the balances included in red. And then I took all of the amount for the asset accounts and I added them all together because I wanted to see, does this balance out with all of the numbers for the liabilities and equity account? And you can see that this balances out. So this shows that the accounting equation would balance out for every transaction that you record if you've recorded it accurately. And this is really important because all of the numbers that is used in your journal entries need to follow a certain sequence and order in order to be summarized to prepare the financial statements. So that's the next topic that we're going to be talking about. How do we summarize the information from the journal entries which are utilized by companies?